When it comes to fixed income investments in the mutual fund space, often people talk about the tax implications, and that has resulted in a shift away from fixed income schemes towards hybrid schemes. Now, for shorter term requirements, a lot of people have been gravitating towards arbitrage funds, certainly, which are equity-like products. But a lot of people have also been moving towards the income plus arbitrage fund, which uses a fund of fund structure. How does a liquid fund compare with an arbitrage fund, and how do those two compare with an income plus arbitrage fund, and what should you invest in? That's the purpose of this conversation. Joining me is Rohit Shah, the founder and chief executive officer of GYR Financial Planners. Thanks so much, Rohit, for taking the time. Let me ask you this. Liquid funds, I think everybody understands. They're debt mutual funds that invest in shorter term paper. What about the other two?
Sure. When you have slightly higher horizon, because liquid funds are like an average maturity of around 30 days, 40 days. So that like what you need to park for a very, very short duration, very, very liquid, nature of the investment that you need. But arbitrage funds are more towards like a 6 months on an average duration. So, this is just like when you have money and you go to a bank, you always decide that I'm going to do the FD for 1 month, 6 months, 2 year or 5 year. The same way, when you have the objective of that saving in mind, and when you do it for a very, very short period, you want to keep it very safe, very liquid, then that's a liquid fund about 1 month or so. A slightly, medium, the upcoming requirements, say about 6 months. So that's about arbitrage fund. Now, the income and arbitrage fund of fund is basically trying to, give you the tax benefit, but also allow you to take a longer exposure in terms of the maturity. So that means before these funds came in, you wanted to invest, let's say, for an income fund or a debt fund of 1.5 year or a 2 year, your only choice would have been, let's say, a short-term fund. But the taxation has changed on the short-term fund now, and there is no, indexation benefit. There is no long-term. There is no short-term, and hence the income come arbitrage funds come into picture, where they manage up to 65% of that fund with a debt component, and about 35% into arbitrage. And after 2 years, it becomes long term, the 12.5% tax category plus the surcharge.
There is also a cost aspect to this, right? And I think most people understand, Rohit, the total expense ratio, which essentially is the total cost that you pay to a mutual fund to manage your money. Now, in liquid funds, it's typically low. Arbitrage funds not very high either. But income plus arbitrage funds, is it the right interpretation to say that it tends to be a little higher because of that fund of fund structure?
Yes, but it is not very high. So, for example, if you look at a lot of arbitrage funds in India, there will be like and if I were to refer to a direct plan, that will be like a 35 basis point or a 40 basis point. So, for example, a 40 basis point is 0.40% per annum. Whereas, the income plus arbitrage fund category is relatively new. So, a lot more options are coming up. And, even if you look at some of the top funds, the total expense ratio, including the fund of fund plus the underlying TR of those fund, is about 45 paise, 50 paise, or a 45 basis point. So slightly expensive, little bit, but it adds a value because you're allowed to go up to about 1.5 year or a 2 year of the duration on the debt side. And in a falling interest regime, this will be helpful to the investor.
Important point that you raise. And so therefore the question to you is, who should invest in which of these products and for what reason? Liquid funds traditionally been looked at as instruments that you should park your emergency funds in, perhaps, or your very short requirement, something that is less than 6 months away, that you don't want too much volatility in. What about the arbitrage and the income plus arbitrage funds?
Sure. So basically, now see, with the taxation benefit gone on the debt fund since 2023 budget, the arbitrage funds are very important for those people who are into the 30% plus tax bracket. So very similar to liquid fund, but if somebody can do a combination of liquid fund for a very core emergency and you park in the rest into the arbitrage, so you are able to save on taxes. So that's the most important differentiation. More important than the tax strategy is the core nature of the underlying purpose of the investment. So if you want to be very, very safe, you're going to be needing the money next month for your daughter's education abroad or something, then liquid funds are much better, even though it's going to tax you more, but it's kind of going to do the purpose. The arbitrage fund, when you have a slightly longer duration, and it is very important to save, that every penny of the tax, because even in a short term, the arbitrage fund will be like a 20% plus plus, and that's like a one third tax burden less than the full income slab. Now, the income plus arbitrage is for those investors, who have a multi-asset class portfolio. They have allocation on the defensive side, and they can park this money for a medium term or a short term duration, which is where the income come arbitrage fund will come into picture. There is one differentiation I wanted to bring out here, Alex, that the tax strategy is great. And I like the fact that the innovation which has come after the tax structure change, that they came out with the income plus arbitrage. But if you notice the budget this year, they said, up to 12 lakh of normal income is can be exempt with that Section 87 rebate in the new regime. Now, what it means is that, and this is a case to case, evaluation, that in some families, it might be better to do a normal debt fund or to do a liquid fund, because then it gets those, the realization, the gain that you realize, they get added to your normal income and get taxed at a slab rate. So, if your total taxable income is not going to be very high, which is possible in, some families, especially not a very active spouse or not a very high income spouse, in that case, you might be able to leverage that. So the caution here is that arbitrage funds, great. Income plus arbitrage fund, great. They're definitely doing good job, providing you various options and also doing, a job of tax saving. But then in some cases, the pure debt fund might as well be better if you're able to do your overall tax planning within that 12 lakh, free limit.
Important points that you raise. What is the return expectation in here, not accounting for tax, pre-tax? What is the return expectation that you should have on liquid funds? And from there, you're building as maybe a spread above that or an expectation above that for arbitrage and for income plus arbitrage.
So if we were to look at today, I think the yields have fallen. Few rate cuts have already come, and I think there is a popular expectation that Fed may cut the rates in the US this month, and even India RBI is likely to follow with one more rate cut. But I think the liquid funds yields have fallen around 5% now, and slightly more, with the arbitrage fund, and the income and arbitrage fund with the slightly higher duration, may be slightly higher, like a 5.5 or a 6%. So it will be linked to the money market status and the interest rates, and this is how it will fluctuate between the three categories.
So, but as things stand right now, Rohit, just so that, and I'm not asking you to be predictive in this, just so that everyone's on the same page. If you're talking about a 6.5 kind of a return that you would get on a liquid fund, you would generally expect that you would get, what, 50 basis points above that for the arbitrage fund? Is that fair to assume, and a similar number for income plus arbitrage?
With income plus arbitrage, yes, because of the current nature, current environment, where, if you take a next 2 or 3 years, I can see that there is some scope for the interest rate to fall. But between the liquid fund and the arbitrage fund, I'm not sure if a 50 basis point arbitrage is a good idea. In my opinion, it will be slightly lower, maybe around 10 to 20 basis point, because the duration difference is not very high. It's about 1 month versus a 6 month on an average.
Understood. So the real difference comes post-tax. I'm wondering whether there's a risk element that you have to bear in mind, liquid versus arbitrage versus income plus arbitrage.
Very good question, Alex, as always. And I think, on a debt market, money market in India, the evolution is relatively on a lower side compared to the equity market. And usually most of us don't realize, most investors also don't realize the risks on the these instruments. I think these are very, very liquid instruments, and most of these would be high quality papers. So I don't see a very high opportunity for a credit risk. What happened during the COVID period was a very, very exception. But I do see interest rate risk here, which is very unlikely for a liquid fund. That happens extremely rarely when there are some, very major overnight actions by RBI. But the arbitrage funds, let's say if you don't have a 6 months duration, and if you're just parking for 2 3 months, then you could have suboptimum or a break even or even a negative yield. So that's one thing to keep in mind. And with the income and the arbitrage fund of fund, we do keep in mind that we are in a falling interest rate regime. But then what happens is that tomorrow suddenly, if there is a crisis, war, recession, something, and the banks have to start increasing interest rate, then there could be a mark to mark negative valuation, and there could be a little bit of impact. Now it's slightly complicated for retail investors to manage this part. So one of the best ways to make sure that they have longer duration, a margin of safety with them, little bit extra buffer they keep in mind, because we are living in some of these uncertain time where things can change quickly.
Yeah, of course, you have to watch out for the interest rates changing, and that usually it takes place after a pretty long period of time. Here we're talking about the possibility of a rate cut later this week. Rohit, thanks so much for taking the time and for explaining this important conversation that we've had today.
My pleasure. Thank you, Alex.
And that brings us to the end of this edition of Your Money Matters. Thanks so much for tuning in.